Great start, and it's being led by tech. Just take a look at the sectors right across the board. Tech's up, semis particularly, Microsoft. You've got Adobe leading the way here. Communication services, our new sector, doing well. Facebook, Google, Netflix, all up. Emerging markets are strong. Consumer staples are lagging, interestingly, and banks are on the flattish side, just turned negative there. Earnings were just great all around, and it doesn't matter what you were looking at, with one possible exception. Goldman beat, Morgan Stanley, Comerica, Johnson & Johnson raised their numbers, their full-year numbers. United Health also had a nice beat as well. So we're off to a great start. So far, Q3, we've got 41 companies reporting. I'm including this morning's numbers, 41 companies reporting, 88% beat on earnings. That is way above normal. 65 is typical. Earnings growth, 25%. This would be the second or third best in years. And the first two are the first and second quarter of this year. Revenue growth is the key here. That's the most important thing because we're up 8%. Typically, remember, 3 to 5% is what you get. We were negative in 2016, so really, these are extraordinary numbers. Larry was talking about that, Larry Fink from BlackRock, about the earnings situation. A lot of debate about peak earnings or not, but, you know, Larry's, I think, goes along with the consensus here. We have a couple more good quarters in earnings. That's Larry talking. The equity markets are overall cheaper today. He did cite concerns, higher costs and tariff pressure, tariffs pressuring margins. That's certainly an issue out there, and that's an issue for the fund managers. Bank of America, Merrill Lynch, they do a monthly survey of all the big fund managers, and this is exactly what they're concerned about. The biggest concern they've got out there right now, the big global fund managers, is a trade war, along with the Fed getting more aggressive than anticipated. So those two things, far and away, are what's weighing on the concerns of fund managers. The China slowdown is a distant third, but still in the running for an issue. So those are the issues here. I think the question for earnings in the stock market is those higher rate concerns. What will offset those fears? Remember, we had this earlier in the year. We had a move up in rates. And what offset it was the tax cuts and the better economy. Everybody calmed down in March. Now the question is, will anything offset those concerns that are out there? And a lot of people are continuing to point to the strong revenue growth, which is going to continue not just in 2018, but into 2019. If you just take a look, we're talking about 7-8% Q3, Q4, even into 2019. Again, these are numbers way above expectations, and the key here is you could talk about higher costs, but if your costs are up 2% and your revenues are up 8% or 7%, that goes a long way towards calming down the margin pressure issue. If your revenue growth is 1% and your costs are 2%, now you got a big problem, but that's not anywhere near what we're dealing with right now. One of the reasons a lot of people are so optimistic. Finally, just back to BlackRock for a minute. It's down 4%. It's had a rough year overall. It was down particularly in September, but all the fund managers have had a rough year in general. I think it's important to note there are still inflows. This is the biggest ETF company that's out there. It's a part of their business, but it's a really critical part. Only with BlackRock, we have $10 billion in inflows, and it was considered a disappointing quarter for the inflows. They've got $6 trillion under management. Money is still coming in, just not at the same rate as before. I would just point out the S&P up 5% on the quarter, emerging markets down 7%. That's a problem. That means you get outflows in things like emerging markets. iShares controls that EM, and that's one of the reasons the flows were not as great as before. Right now, sitting right near the highs for the day.